Financial accounting. Chapter 5, accounting for merchandising businesses. As a quick reminder, merchandising means retail. This is your stores that don't manufacture, but they sell a product. And we're dealing with a more complicated financial statement. We've got inventory added, we've got cost of goods sold, a lot more complications than with service businesses. So the first thing we need to talk about is this perpetual inventory system. Perpetual systems are very common in today's business world because of the automation of business. The barcoding, the barcode stickers that are very simply placed on the side of a product or that are automatically there. So whenever the store buys inventory to place on its shelves, it's entered into their system as inventory. And when the customer purchases this inventory, it is scanned and the sales price is automatically recorded as a sale, and the inventory is automatically recorded as a cost of the sale, and inventory is reduced and cash or accounts receivable goes up. So it's really a cool process of automation, continually updating during the accounting period so that the business owner can make decisions about what's left. And let me remind you about Walmart the next time you go into one. They have the most automated and the most sophisticated system out there. Their system constantly updates for inventory. Employees of Walmart, if there were to be a break or a spill of any type of product, or maybe they accidentally dropped a case of, pickles on the floor, and they burst, then the employees are required to immediately record the fact that that inventory is gone. And this is a constant updating so that Walmart can keep track of the system that they very tightly control, that shows everything from how much is on the shelves, how much has been sold, how much needs to be shipped from the distribution center to each individual store, what their margins are. Very, very sophisticated system. So let's talk about this perpetual inventory system. And you see my warning on this slide. There are 2 journal entries related to a perpetual inventory system. These journal entries relate to the sale of the product, and the second journal entry relates to recording the reduced inventory. Okay, let's look at the sales transaction. Revenue is generally recorded as sales. Sometimes sales of merchandise. Sometimes you'll see the word revenue. Sometimes you'll show subcategories. So Walmart may show sales from their lawn and garden. They may have a sales category from their clothing, sales category from their grocery, even subcategories within the grocery area as far as produce versus meats versus canned goods versus alcoholic beverages. Let's just take the simple ones. Okay, in this example, we have cash being recorded for $1,800 and a sale being recorded for $1,800. Here's our debit and our credit. Really simple journal entry with the explanation here, and I'm sure you can imagine this in a T account format. Cash sales would also have the entry to record the decrease in inventory. So the inventory has already been recorded as an asset when it was purchased. Then whenever it's sold and you record the sale, then cost of goods sold is recorded. Big reminder, stop, pause, take note, memorize. It's always best to keep this in your own personal handwritten notes. Cost of goods sold is an expense. It goes on the income statement. It is the cost of the product that was sold, the product or the goods. Cost of goods sold. Sometimes it's called cost of sales. And in this, we record cost of goods sold as a debit and inventory as a credit. This inventory credit is showing up as a reduction to the asset. So again, reminder, cost of goods sold is an expense. Inventory is an asset, and this asset is being reduced whenever we record the fact that this inventory was sold. All right, let's look at an example of the 2 journal entries required whenever the merchandise is sold on account. And again, remember, On account means an accounts receivable. So in this case, Net Solutions, the company we use in the text, has sold merchandise for $18,000. The cost of that merchandise that was sold is $10,800. And so we've got, instead of cash, we've got accounts receivable of $18,000. Pause here. Accounts receivable is an asset. It's a current asset because we expect to collect this within the next year. And we're recording this because the customer, instead of paying us, said, charge it. Charge it to my account. So if you're having trouble with the concepts, it's related to the accrual accounting method. Accounts receivable is an asset, and it's recorded whenever a customer purchases something but doesn't pay for it yet. They say charge it or charge me. It's not a credit card. We'll see that in a few minutes. It is a charge. So let's see if I can give you the best example that might be familiar. If you're if you work in construction, you're a contractor, you can actually go to Lowe's or maybe 64 Lumber, and you can set up an account. And when you go through, you'll say, hey, charge this to Smith Construction Company account. And at the end of the month, Lowe's will send a bill to Smith Construction showing that Smith Construction owes the money. And that's what this case is. Net Solutions has a customer by the name of Digital Technologies, and this is a subsidiary ledger that shows all the money that Digital Technologies owes Net Solutions. In this case, it was invoice number 7172, as we can see from the explanation. Here's the sale being recorded. It's the same as revenue or fees earned. Debit 18,000, credit revenue 18,000 or sales. And at the same time, because we're using a perpetual system, cost of goods sold is being increased. The expense is being increased, and inventory is also being decreased. Our debits equal our credits. Inventory is an asset. It is reduced by a credit. So it's interesting in this first journal entry up here that we've got on March 10th, we've got an asset increasing and we've got revenue increasing. In the second entry, we've got an expense increasing and we're showing that the asset of inventory has decreased. So our books are in balance, and this is recording our information related to one sale. Now, we've got to stop and look at the gross margin. I want you to look at this transaction, remember what gross margin or gross profit means, and see if you can calculate gross margin. I'm going to pause for a minute. Okay. So what did you look for? What did you look for? Hopefully, what you've looked for is the let me get rid of these this ink on here. What we're going to look for is the formula of sales minus cost of goods sold equal gross margin. And the sale, $18,000. Cost of goods sold, $10,800. When we subtract those two, if we were to prepare an income statement just from this transaction, we would see that Net Solutions has a margin or a gross margin or a gross profit of $7,200. As a reminder, this is the money they made off of this one transaction before paying expenses like wages, insurance, taxes, rent. There's just so many other expenses. Okay, I want to provide an example for students to work on. Looks like my margins are off a little bit here, but since I'm in the middle of recording, I unfortunately can't go back and start all over again. I'd have to shift it over. So let's look at this example. It says, assume that on July 24th, a company had a cash sale. This should be of $11,000. The 3 zeros kind of slipped outside of the margin. And the cost of goods sold is $7,000. So your accounting should now be at the stage where you went, okay, sold something for $11,000. The cost was $7,000. Looks to me like I made a nice profit of $4,000. I need to learn how to record this in the T accounts. So I put some T's here. You might want to put these T's on a piece of paper and try this transaction to see how well you can do with it. You're going to have to label the T's. We're not going to use all 6 of them. I want you as a student to figure out which accounts are needed. It would be the same accounts that we just used when we recorded it in journal entry. Label the T accounts and show what this transaction would look like. Now, as a reminder, we're just showing partial entries. We're not showing all of the entries related to this one transaction because, of course, inventory had to be purchased in order for there to be a reduction of inventory of $7,000. So take a minute, jot this down. It's the best way to learn. And let's move forward to the answer. Okay, so here we've got it. July 24th, Band Company had a cash sale of $11,000 with a cost of $7,000. So we're going to use the sales and the cash accounts for the first transaction. Sales, $11,000 are recorded. Sales are part of stockholders' equity. They're increased with a credit. And we received cash, so we will debit cash because cash is an asset. We've increased our cash account by $11,000. Remember, with all transactions in a perpetual system, we have 2 pieces to it. So part 2 is we've got to record the related costs. So that related cost is called a cost of goods sold, listed here. Remember, it's an expense, goes on the income statement. It reduces stockholders' equity. Also, inventory has to be recorded. Inventory is an asset. $7,000 debit for that expense, $7,000 credit for inventory. Again, we're only showing partial entries, so obviously there's other cost of goods sold. We've got other sales, more cash. We had some inventory, but we sold it. So we're not showing anything but the effects of this one transaction. So this is what it would look like, and I hope that you've taken the time to try this sample out before looking at the solutions, because that's the best learning opportunity. Let's talk about cash sales made using a credit card, because this is often extremely confusing for students. So if there's a credit card being used, such as a MasterCard, a Visa, American Express, it's considered to be a cash sale. So the retailer will take those credit card slips, deposit them in the bank, or it's automatically happening whenever they run it through their computer system, and they automatically receive the money from it. So this is not a sale on account. When you go to a store and you make a purchase with a credit card or a debit card, then that store automatically receives the cash. So it's recorded as a cash sale. I need to remind those of you that may not know, or maybe this is a new concept, your debit card makes the store, the retailer, the merchandiser happy because they don't pay a fee. But any store, retailer, restaurant, any business that takes your credit card has to pay a fee. It can range from 2 to 4%. American Express typically charges a bit more for their fees. MasterCard and Visa charge less, but if you as a customer were to go into Walmart and buy $100 worth of a product, Walmart might only receive $97 because they're going to have to pay a $3 fee on the sale of that product. Why is it called a credit card? I think we've discussed this before, but just as a quick reminder, banks are a little bit backwards because whenever you make a deposit into your bank account, the bank has a liability. Whenever you borrow money from the bank has an asset, which is loans receivable. So if this makes sense to you, you really are grasping the concepts of debit and credit. If it doesn't make sense to you and you want it to make sense, shoot me an email and I'll be glad to explain it. Alternately, it's not something we'll be worrying about in this intro course, but for a lot of students, they're saying, I don't understand the difference in a debit and credit card because it's backwards from what we're studying. And that's because okay, other terms. When you read through chapter 5, there is a massive amount of terms: customer and sales discounts, cash refunds, cash allowances, refunds payable, credit memos, trade discounts, returns inventory. All of these are important terms that are used in different businesses. We're not going to be talking about them specifically. You may see one or two on your homework, but of course your homework you can always do with your book open, and you have as much time as you need as you're doing your homework problems. They will not be tested on an exam, but for students that are going into upper levels, these are terms that you may be using in another class, but I think they're just way too extensive for an intro class. So skim over them. They're important to know if you're going to work in retail. They're important to know if you're going to be an accounting major, but for the non-accounting majors, just know that we got a lot of terms related to merchandise transactions. Freight. This is an important term. Since Charleston's a shipping port, I thought that we might stick a picture of a container ship up there. Freight is often a part of the purchase and sale of merchandise. And the question is, who pays for the freight? And that's an important question in a business world. So accounting is the intro to business because there's so many business concepts. So who pays for freight has the issue of ownership and control and insurance and liability. So if the product is put on a UPS truck at the warehouse and shipped to the customer, who owns it while it's in transit? Who's responsible if that truck has an accident or if it gets damaged in transit? And that's part of our question related to freight. So be prepared. We're going to have two different concepts about freight. One is FOB shipping point. The next slide is going to be FOB destination. But let's talk about FOB, free on board. This means that the buyer pays the freight cost. And so that's when you go in and you purchase something online and you're responsible for the shipping. Then your cost is the cost of the product plus the shipping. So in a retailer, the total inventory cost includes the inventory itself plus the cost of the shipping. So the seller doesn't have to pay any of the shipping, and try to do it in a smiley face format. We got a happy seller, and the buyer's like, okay, great, I've got to pay for the shipping. And that's going to be included in the cost of the inventory. I'm going to pause here too. Inventory cost. So important that you understand that inventory is recorded at cost. And we're trying to figure out what's included in the cost. And if it's FOB shipping, freight is included in the cost. Now, FOB destination is just the opposite. The seller's going to pay the freight. So the seller's responsible and owns the product until it gets to the customer. And it's going to be a cost of the seller to get the product shipped to the customer. The buyer does not take ownership. They don't have to worry about any liabilities related to it until it gets to the destination. So FOB shipping point, FOB destination are two options. Looking at it from an illustrative purpose, you can see this is from your textbook. FOB shipping, FOB destination, and they talk about who has title of this product. And it really would be important whenever you start looking at, for example, in Charleston with the port where they ship the BMWs that are manufactured in the Greenville area, who owns it? FOB shipping point means that the person, let's say in England, that's buying a load of BMWs off of the shipping container, they are paying for it, they own it. But if it's FOB destination, then the BMW company out of Greenville is paying for the shipping, and they've got a delivery expense, as you see down here, to get it on that container ship all the way over to maybe the car dealership in England. But the seller would be the individual that's paying the freight and that owns it until the title passes to the buyer at the destination. Okay, this is a really complicated looking but helpful slide, and it shows what can happen from the seller's perspective and from the buyer's perspective. All the different transactions of how one store has inventory and one store has cost of goods sold. So just wanted you to take a minute to try to understand the two perspectives, because every time a transaction occurs for a seller, then there's a similar transaction that's going to occur for a buyer in most cases. And this is a really, really helpful illustration to show these inventory transactions. So let's just take the first one. Scully Company sells merchandise to Burton Company. So Scully gets to record the accounts receivable, and they show that the inventory's gone down. And then whenever the Burton Company gets it, notice that they record inventory of what they paid for it, the $7,500, and they show that they've got it in accounts payable. So for those of you having difficulty still with accounts receivable and accounts payable, Scully has a receivable from Burton. Burton has a payable to Scully. Burton now has inventory. There are 2 pages of these transactions. It is helpful for students to take the time to look at them one by one. And here is page 2, all the way through to customer refunds that could possibly occur. This slide shows the chart of accounts for a merchandiser, and it shows all of the new accounts that we've been adding in the merchandising area: inventory, estimated returns, customer refunds, sales, cost of goods sold, and delivery expense. And these are all new areas. In this course, for the way that I'm approaching this course, we will be focusing on the fact that we've got inventory, the fact that we've got now sales instead of revenue or fees earned, and that we've got cost of goods sold. These are going to be our primary new accounts. We're used to having accounts receivable, which means that customers bought something and charged it. We're also used to having accounts payable, which is the money that we owe to others. Sales tax. If there's a sales tax, let's say a 6% sales tax in this example, then we would record the sale of a $100 item. Although we receive $106, we've got $6 in sales tax payable, and this is going to be a current liability. So you can quickly see from this illustration they've got at the bottom, how much would their sales tax payable be here? Looks like they've got a 9.75% sales tax on a $100 sale. The retail store doesn't get to keep that sales tax that they've collected. It's a current liability. They'll write a check to the state or to the county or to whomever the sales tax has to be remitted to, and it's a current liability. So this is going to end slide 2 of 3. We're going to talk on the last slide for the last PowerPoint set for chapter 5. We're going to be talking about what the new income statement is going to look like.